morning everyone, welcome to Morning Markets. My name is Chris Leyland and I'm Director of Investment Strategy here at True Potential, and the goal of this video series is really to give you an insight into how the investment team are thinking about key events on a daily basis. So today we're going to discuss the Federal Reserve's policy meeting. So the Federal Reserve said it will begin scaling back its massive $120 billion monthly bond buying program this month. So that's a milestone for the US economy that is recovering from the pandemic. The decision is the culmination of months of debate among Fed officials about the level of support the US economy needs. The move corresponded with other central banks around the world tightening monetary policy, including the Reserve Bank of Australia and the Bank of Canada. Obviously, we're all watching what's happening with the Bank of England, which meets today, and they will potentially raise interest rates for the first time since 2018. Investors are betting that the European Central Bank could follow suit next year, despite recent pushback from its president, Christine Lagarde. Against the backdrop of a robust recovery, the FOMC ended its two-day policy meeting with a pledge to reduce its purchases of Treasury securities by $10 billion a month. So the central bank will also reduce its purchases of agency mortgage-backed securities by $5 billion a month. Looking into the speech itself, the FOMC said it was able to withdraw the stimulus because it had achieved, in its words, substantial further progress towards its twin goals of maximum employment and inflation that averages 2%. So the tapering process is set to begin in mid-November, which suggests the stimulus program will cease in June next year. The purchases will be reduced by the same amount in December, and further reductions were deemed to be likely be appropriate each month thereafter. The Fed committee said it was prepared to adjust the pace of the tapering process if warranted by changes in the economic outlook. At the press conference following the announcement, so Jay Powell, so he's the chair of the Fed, said the central bank was prepared to speed up or slow down as needed. If we feel like something is happening, then we'll be very transparent. We wouldn't want to surprise markets, he said, adding that even after the Fed stops expanding its balance sheet, its holdings of securities will continue to support accommodative financial conditions. The Fed on Wednesday also tweaked the language it used to describe the inflationary outlook. So it said the factors driving upward pressure on prices are expected to be transitory, whereas previous statements said inflation was being largely driven by transitory factors. At the press conference, Powell underscored the severity of the supply and demand imbalances that have contributed to sizable price increases in some sectors. He stressed that the Fed's view was that these bottlenecks would eventually abate and help bring down prices, although they will persist well into next year. But what's our view? We believe the Fed have acted as expected. Tapering of asset purchases, a form of tightening of monetary policy, is only taking place because the Fed believe the US economy is far enough through the recovery to withstand it. Powell's been very clear he doesn't want to surprise markets and doesn't want to destabilize the US economy. Market reaction was strong, with the more technology-focused index leading the way, so the NASDAQ index in the US performing the best, closing over 1% up last night and actually hitting a record high. Okay, that's everything from me. I look forward to speaking to you soon. Thank you.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.